Everybody, I want to tell you, my name is Christopher Chang. I want to start off with a short story about a situation that I was dealing with about 2 years ago. So I had a client that came to see us. He received a tax document from his local bank here in Hong Kong for some dividend payments, about 500 US dollars of dividend payments. There was some US tax that was taken out of it, and so he's asked, "Hey Chris, can I get this money back?" It was, let's say, about 200 US dollars of payments that were taken out, and he's wondering, "Hey, can I get this money back?" So start to look at his tax situation, understand, are you a US citizen? Are you not a US citizen? Have you been traveling to the US? How many times have you gone back? So go through his information, come to find out he was actually in the US for 3 trips last year, about 2 months each of those trips. He was actually in the US for more than 6 months in the prior year. When I looked through all his other information, came up is how much income he was earning in Hong Kong and also here in Hong Kong. Realized that he had about a 50,000 US dollar tax bill, which is surprisingly unexpected. We found a few ways to help minimize that, but at the end of the day, he did have to pay a tax bill. And so, what I hope to help you understand today is how to prevent this from happening. Firstly, how to prevent unexpected surprises. Secondly, is how to summarize, to get a basic understanding of the U.S. tax rules and laws, and how to help make some better informed decisions and about what you need to be aware of as being a U.S. person or being not a U.S. person. So here's a short background about myself. I'm a U.S. CPA, founder of our company, American Pacific Tax. We specialize in doing U.S. individual taxes for individuals living and working in Hong Kong and Asia. We've been helping out a number of clients here who are investment bankers, working at banks like JP Morgan, Goldman Sachs. Some of them are directors of multinational companies like Google, LinkedIn, Tesla. Some are international school teachers, university professors, and also not a lot of non-U.S. people. Some of them have invested in U.S. Real estate. Some of them have U.S. stocks, or some of them just have some pre-immigration planning questions as well that they want to come and run by us. So we're based in Hong Kong, and we've been here for nearly 8 years now. You can also find the company on a few of these different websites: U.S. Consulate, IRS listed tax return preparers, and Asia Expat. So let me get everything ready for you. So I'm trying to get into the slideshow view. So now we're all set. Sorry, review from beginning. Okay, so now we're all set. Second, I want to tell you about short background about U.S. income tax overview. So, U.S. citizens and green card and resident aliens or green card holders are taxed on their worldwide income. They also need to file U.S. taxes on an annual basis. Usually, it's due on April 15 every year. People living overseas get a 2-month extension to June 15. This year, there's been a lot of surprises. So this year's tax deadline is July 15, something very new. First time this has happened for me in my career. And you can see that some of the most common types of income are salaries, interest, dividends, capital gains, owning your own business, or rental income as well. U.S. income tax rates range from 37% up to 37%. But usually most individuals are not paying U.S. income tax at a 37% tax rate. Lower rates can begin at 10%, and this is very different from the Hong Kong rates. Whereas Hong Kong, it's a base 15% flat rate, so U.S. taxes can be considerably higher. And as you saw from the previous slide, there's a much wider scope of types of income that is also subject to U.S. income tax. Corporate taxes are 21%, flat 21%. Previously, they're 35%. As well, so it's something to keep in mind. What I haven't covered here is 37% tax bracket can also be increased if there's any state income taxes as well. Some states can have a tax rate as high as 10%. States that do not have an income tax are Florida, Texas, Nevada, Washington State. So these are just a few of the common states that we've had clients that live in that do not have a U.S. income tax as well. So now, in addition to the U.S. income tax filing requirements that need to get done, there's also something called disclosure requirements, which is something that's not very common in Hong Kong from our experiences. But annually, every year, a U.S. person needs to do an FBAR reporting, which is disclosure of their highest bank balance of their foreign accounts, meaning non-U.S. bank accounts. So, for example, somebody has a bank account in Hong Kong HSBC with 100,000 Hong Kong dollars in it. They need to tell the U.S. government, hey, I have 100,000 Hong Kong dollars in my Hong Kong bank account. This is needed to be done every year. In addition, there might be some additional disclosure that's required with the U.S. income tax return as well. But the FBAR is really required for bank accounts, investment accounts, life insurance policy or cash minimum value, stock certificates, maybe an investment in a closely held business. So these are just a few, and this list can be quite extensive. You can see some of the various types of tax forms that need to be filed. I've listed just 5 of them, but this list can be, there's hundreds of them. One for every different tax rule, tax law. I've listed out the 8938 here, the FBAR, Form 1040, Schedule B. These lists go on and on. So every type of tax rule and law, you can find another tax form. So that's why we have a lot of fun looking through our lists every day as well. So for a lot of individuals here, which I'm assuming that many of you are non-U.S. individuals, not a U.S. person, not a U.S. green card holder. So why is it so important? Because as a U.S. resident, they need to report income on a worldwide basis. They might have deductions available, and yes, disclosure is required. Whereas a non-resident alien, there is not worldwide income tax reporting, but only U.S. source income. Might be some deductions. Disclosure may or may not be required. So you can really see that when a person becomes a U.S. resident, they got all this work to do. When they're not a U.S. resident, there is less things that they need to do that's related to the U.S. So now, next question I'm sure you're asking is, how do you become U.S. resident? First way is that individual meets the green card test, or they meet the substantial presence test, or they simply make an election, which I'll go through some of these explanations in the next few slides. So what is a green card? What is a green card test? It simply means that the individual has it's simply a card looks green, but basically it's a lawful permanent resident status. It allows an individual to live and work in USA, and it can be obtained through obtaining a green card, or it can also be done to the EB-5 program, which is called a conditional green card. Starting date for U.S. tax residency is the date you get the visa and the date the individual steps foot in the USA. Very, very important date that you need to be aware of. So in that year, the individual is also considered a dual status taxpayer. So again, once they step foot in the U.S., they get a green card, they're going to be treated as U.S. resident aliens. Remember, worldwide taxation, disclosure that's required. So it becomes very important to plan accordingly. Substantial presence tests. This is really what the story was that I explained to you a bit earlier. So individuals simply spent too much time in the USA, and by spending too much time in the USA, they become subject to worldwide income tax reporting. And that's why this individual had this big tax bill. So if an individual spends more than 183 days in a 3-year rolling average, they're going to be treated as U.S. resident for tax purposes, And really, this can really be something that can be planned and prevented. Meaning that we've talked to a lot of people who got close, but as soon as they met with us, we told them, you better start keeping good track of your travel schedule, and your calendar better be accurate. Another option is simply by choosing to file an election, be treated as a U.S. person, which could be beneficial for many taxpayers.